Most traders think managing risk means setting a stop loss and hoping the trade works out. That is not risk management. That is wishful thinking dressed up as a plan. Professional traders think about risk in a way that will genuinely surprise you, and once you understand it, you will never approach a trade the same way again. Stay with me for the next few minutes. What I am about to show you is the exact framework that separates traders who last from traders who blow their accounts and disappear. The foundation of professional risk is one rule so simple it sounds almost too basic to matter. Never risk more than 1% of your total account on any single trade. On a $10,000 account, that is $100 of maximum possible loss per trade. Not your position size, your maximum loss if the stop hits. This single rule means a trader can lose 50 consecutive trades and still have more than 60% of their account intact. 50 losses in a row, still trading, still learning, still alive in the market. The 1% rule does not make you profitable. It keeps you in the game long enough to become profitable. Most beginners pick a trade and guess how big to go. Professional traders calculate position size mathematically every single time. The formula is simple. Position size equals your account risk divided by your stop loss distance. If your maximum risk is $100 and your stop loss is 50 points away, your position size is 2 units per point. This calculation never changes based on how confident you feel. It never changes based on how good the setup looks. Confidence is not a variable in the formula. The math is the decision, every time, without exception. Professional traders set a maximum daily loss limit, and the moment they hit it, the trading day ends. No exceptions, no second chances. The standard professional threshold is 2 to 3% of total account value. Hit that number, close the platform, and walk away. This rule exists because bad trading days cluster. One poor decision in a compromised mental state leads directly to the next. The daily loss limit is the circuit breaker that stops a bad hour from becoming a bad week. The platform closes, the losses stop, the psychology resets overnight. Here is the statistic that surprises most people. Many consistently profitable traders have a win rate below 50%. They lose more trades than they win, and they are still profitable. The reason is risk-reward ratio. A trader who risks $100 per trade but targets a minimum $200 profit needs to win only 1 in 3 trades to break even. Win 4 out of 10 trades, and they are meaningfully profitable. A 40% win rate with a 1-to-2 risk-reward ratio is more profitable than a 60% win rate with a 1-to-1 ratio. Professional traders do not chase high win rates. They chase high-quality setups with strong risk-reward ratios. Every professional trader has a drawdown protocol, a structured response to losing streaks that prevents psychological damage. Phase 1. At a 5% account drawdown, reduce all position sizes by 50%. Trade smaller until the account recovers. Phase 2. At a 10% drawdown, stop live trading entirely. Switch to a demo account and review every recent trade. Phase 3. At 15% drawdown, take a mandatory break of at least 1 full week. This protocol exists because losing streaks impair judgment, which causes larger losses. The protocol interrupts that cycle. Most retail traders never think about this. You open 5 trades across 5 different markets and believe you are diversified. But if those 5 assets are correlated, you are not running 5 separate 1% risks. You are running a single 5% risk. In market stress events, correlations spike dramatically. Assets that normally move independently suddenly move together. True professional risk management requires knowing not just the risk on each individual trade, but the total combined directional risk. The protocol interrupts that cycle before it becomes irreversible. A trading journal records what you traded. A risk journal records something far more valuable. Before each trade, what is your planned risk? Does it comply with the 1% rule? What is your emotional state right now? After each trade, did your actual position size match your calculation? Did you honor the stop loss? Did you follow the drawdown protocol? These metrics tracked daily reveal patterns invisible to someone only watching profit and loss. That knowledge is worth more than any strategy. The final shift is psychological. Retail traders experience losses as failures. Professional traders experience them as business expenses. A restaurant owner does not call food costs a failure. They are a known, managed expense of running the business. A loss within your 1% rule, executed with a written plan. That is the cost of running a trading business correctly. When losses stop feeling like personal failures, decisions become consistent, and consistent decisions produce profit over time. Risk management is not a feature you add to your trading. It is the foundation everything else is built on. Remove it, and a strategy becomes a series of bets. Apply it consistently, and a strategy becomes a business. The professionals you admire decided that protecting capital and following a system was the only goal. Protect the capital, follow the rules, let the math do the rest. Share this with a trader who is focused on winning trades instead of managing risk. The next video is right there.